We have a tried and true 5-step investment process that we follow all the time. And I'll give you some of the highlights. So we start off with thinking about the macro environment, where we think about what return potential there is in the market. And that helps us decide how much risk we want to take in our portfolios. And again, the amount of risk we want to take is really important because we want our results to be very strong on a risk-adjusted basis. And when we're doing that, we're working really closely with a world-class set of macro research analysts that are dedicated to fixed income and are experts in central bank policy and economies both in the US and abroad. From there, we move on to thinking about sectors. And one of the fun things about my role at Fidelity is that I get to work with great teammates that are specialists in each of the different asset classes. So for example, I talk almost every day to somebody who manages high yield or leveraged loans or mortgages and get a lot of really great insight into what's happening in those markets, both from a fundamental perspective and from a valuation perspective, which helps me make really good decisions in terms of which sectors are attractive and which ones to allocate to within the portfolio. And from there, we move on to what we call security selection. And that's where fundamental research really shines. We like to say that research is the engine that runs 24/7 at Fidelity, but it also helps us identify really great opportunities that can add a lot of value to the portfolio. I think the fixed income market is really attractive. If you look at the level of income that's available in the market right now, it's a lot higher than it's been in recent history. In fact, we've been running at close to the highs of the last 20 years. So there's a lot more income in the market, and that starting level of income, in other words, the yield in the market, is a good way to think about what returns might look like in the future. It's not a perfect indicator, but it's a pretty good starting point for thinking about it. And it's important also when you think about why people own bonds. So people tend to own bonds because they generate income. They also help protect your capital. And also that starting yield being higher helps with diversification. We've taken a look at how diversification has played out in the most recent bouts of volatility, and what we've seen is that diversification benefit is back. On days when stocks are down a lot, bonds tend to be up in price, which is really helpful from a portfolio construction perspective.